Friends, till 24th June 24, we have completed block 1 on the concept and determination, where we have covered conceptual framework, operating environment of working capital, determination of working capital. Then we have covered block 2, where we have covered management of current assets was the big title, and under the subtitle it was management of receivables, management of cash, management of marketable securities, and management of inventories. Thereafter, we have completed block 3 on the topic financing of working capital, where we have covered theories and approaches, payables management, bank credit, principles and practices, and other source of short-term finance. Friends, last time we have covered block 4 also in part on working capital management issues and practices, where we had covered unit number 12 on working capital management in SMEs. Today we are going to cover the remaining part of working capital management issues and practices, where we are going to cover unit 13 and unit number 14 on the working capital management in large companies and working capital management in MNCs. Let us just start with the unit number 13, working capital management in large companies. As an introductory part, let us just understand once again what is the working capital management. The working capital management is one of the most critical aspects of day-to-day business management. Friends, working capital management is a fictional area of finance that encompasses the firm's entire current assets. It is concerned with the link between the company's short-term assets and its obligations. You know, the working capital volume can fluctuate significantly over time and differ from one firm to another. It could be different for the manufacturing concern, could be different for the trading concern, and could be different for the service sector. But it is critical to consider this metric in a broader, more holistic context. When evaluating financial stability based on the net working capital levels, the industry, firm size, growth stage, and operational model of the particular business must all be considered. Friends, working capital management is a collection of activities carried out by a firm to ensure that it has adequate resources to cover day-to-day operational expenses. Operational expenses, that means if it is a manufacturing company, first and foremost job would be production. So for the production, day-to-day operational expenses, you need to have working capital, while also ensuring that resources are invested productively. Suppose you have enough cash or extra cash or idle cash, you can invest them also productively. You don't just keep them idle. It is significant because the company has sufficient resources for its everyday operations, ensuring that the company's existence is protected and it can continue to operate as a continuing concern. Friends, if suppose it is just coming out to be your day-to-day expenditure, suppose this class has started and all of a sudden we have any jerk or any problem, definitely there will be a sort of small but significant break in between. So better that we have to just keep all those arrangements well in advance. It could be the fixed expenditure, it could be the recurring expenditure to convene this class smoothly. So that is covered under the working capital management. Significance of working capital management. When we just talk about the significance, as I've already explained just a minute before, that working capital has got a vital meaning for any working organization. In general, the chief financial officer of working capital is responsible in assuring that the organization's ability to fund various current assets with current liabilities to a considerable extent. With the current liabilities to a considerable extent. It should not be more than the current assets, so that at least at times you may have the shortage of cash. So a comprehensive approach should be taken encompassing all company activities relating to both short and long-term assets. Friends, in practice, working capital management has become one of the critical concerns in any firm, with many finance executives attempting to find working capital ruminants and basic debtor optimum working capital levels. Coming back to our topic of Unit 30, large and small firms financing options. From the management standpoint, the method of financing working capital of various sizes of business firm is a topic of debate. There is a wide range of financing options accessible to a business, each with its own set of advantages and limitations. The size of a company has an impact on the floating of money in general and working capital in particular. Large companies, unlike small entities, may raise funds in capital markets at a minimal cost. Why? Due to their size and reputation. Furthermore, with bigger companies, the sort of security and methods for raising funds is more amicable. You see, for smaller firm, there are n number of issues, n number of challenges which are just coming in between, and thereby you are just finding out that their funding, their financing options are coming out to be difficult. But not for the large companies, because they have the minimal cost for raising their working capital. Business financing. Business funding serves a variety of functions. It could be to start a business or for working capital, such as to buy raw material or to cover everyday requirements. Alternatively, a company may need funding to develop or grow, as well as to purchase equipment or land. This is the next course of action. Once you are just in a position to just take care of your day-to-day expenditure, you can think of going for the purchase of equipment and land. For that, of course, it is the expansion plan. Types of funding. Large firms have the same alternative as small ones. Options are same, only the size and the challenges are different. But they have a much wider range of possibilities. They may turn to business loans, such as those given by large banks and other financial organizations to meet their financial demands. They can also use accounts receivables factoring or take loans against their existing purchase orders. These are the kind of fundings. Difference in SMEs and large companies' working capital. The contrast between the large companies and small and medium businesses are now explored in the next section. For numerous reasons, large businesses have different access to finance than the smaller firms, have already explained. Let us just look at the first part, the funds arrangement. The larger companies indeed have greater assets, while those assets might be used as collateral, which is certainly a significant benefit. They can also be sold in a crisis. Larger organizations have a longer and more extensive company history. Any type of financial investments, such as lending money to a company or purchasing shares in the firm, is dependent on the firm's history and projections about the firm's future performance based on that history. The larger corporations have a stronger reputation than the majority of smaller corporations, already explained. In this scenario, just having a good reputation can be enough of a guarantee. We have another significant distinction between large and small businesses funding is that the larger firms can be more discriminating. Not only will a larger company be seen as a good candidate for a variety of funding solutions and will receive several offers to that end. Because the larger companies have less perceived risk and greater proof of their financial status, they will be to acquire funding at a cheaper rate than the smaller competitors. It is just because of their history and the assets they have acquired for. Small business enterprises frequently require some type of capital to start their business, expand it, or even keep it afloat when times are rough. While funding is frequently required, it can be difficult to secure and can put them in financial bind. Unlike major corporations, small businesses face a variety of risks when it comes to funding. Size of debt. If you borrow more money to start a business, you may find it challenging to honor the interest payment. So it should be moderate according to your need and the capacity to pay. Next is relinquishing control. Some type of financing may require you to give up some influence over your activities. Okay? Because it becomes a financial bind. And then you have to stop or you have to give up some influences over your activities. Or maybe something stressed sometime. Reluctance to retire. This is very interesting. Those who start a small business later in life may be forced to spend cash set aside for retirement to meet the needs of the firm. If the firm fails, it will lose not just the business but also the chance to retire at a certain age. You know what happens? Then the individual may be obliged to work much beyond the typical retirement age or beyond their time of retirement. Personal relationship. The aspiring small firms indeed borrow money from relatives or friends to get a low interest rate or as a last resort. If these firms collapse or their owners fall behind on payments, their connections, quote unquote, their connections may be in dispute because they are all near debts. Even if a bank loan is arranged, the stress of having to repay the loan may cause affect personal relationships. Losing assets. When we apply for a small business loan from a bank, we are typically required to put some form of collateral, such as a car or even our home, to secure the loan. If the company fails to make it, it will also risk losing some of the personal property of the owners of the small firms. So they are always at a given risk by putting their vehicles or their homes as collateral security. Resources of individuals using personal funds to finance a business is a direct approach to doing so. This can be done by putting savings towards business expenses, taking up a line of credit, cashing out retirement asset, or borrowing money from friends and relatives. In case of small businesses, the majority of new enterprises are self-funded because they have to make their credibility established, and then only somebody else would be accepting the collateral or their credentials to loan for their proposals. Borrowing. A business loan is often obvious source of debt financing. Small business owners frequently borrow money from friends and family. In the beginning, of course, at a later stage also sometime. But if you have collateral to put for the loans, commercial lenders are a choice. Friends, if you have collateral, if you have some assets with you which you have acquired earlier than starting this business, well, of course, you can just skip those money to be received from friends and family. Installment purchases. This is another trade credit. A business owner that take a mortgage on a building, buys a vehicle with a car loan, or purchases equipment with dealer. Financing is doing nothing more than acquiring debt financing. Okay. This, of course, is a loan where they are just mortgaging the building or the equipment or any other component which has been mortgaged. Trade credit, whereas it is just coming out to be the contract with the suppliers, where you have a short period, of course, but then you are using the trade credit buy now, pay later. You'll be surprised to note that even in the government now they have started this practice with the people who are having sound credentials, like the post office, which does book now, pay later with their premium clients, not with everybody. Bonds. Small firms do not consider using bonds to raise for long term investment. Even so, it is something to keep in mind when the company is well established and needs funding for expansion. Let us now look at the factors affecting large companies' working capital. All firms have different working capital requirements. It depends from company to company. What are the parameters? The working capital needs is determined by the nature, size, structure, age, and management structure of the company. The volume of business operation, that is small, large business firms, has a significant impact on working capital requirements. There are two types of factors that can influence. One, working capital requirement, endogenous and exogenous. The size, structure, and strategy of a company are all endogenous elements, whereas the exogenous elements include banking access and availability, interest rates, industry, and products or services sold, along with the economic conditions and the size, quantity, and strategies of the company's competitors. The external factor, the internal factor, in a simple words, if you can explain. The following are the major elements of working capital that have an impact on the performance of large business firms' working capital. To manage the working capital effectively, one has to understand the various components of working capital and the working strategy of the executive of the large companies. Managing liquidity. Liquidity management guarantees that the organization has enough cash on hand for both routine operations and unforeseen expenses on of an or of an acceptable magnitude. It is also significant that since it influences a company's creditworthiness, which can decide the future of a corporation. Managing liquidity. You may say no to any one of your supplier, but you know what would be the credit worthiness of your next order may not be. So the future of the corporation would be at a risk if suppose you are not managing the liquidity adequately. Taking care of receivables, a firm should provide its clients with the appropriate level of flexibility or commercial credit while ensuring that the appropriate quantity of cash flow through activity. A company will select the credit conditions to offer depending on the customer's financial strength, the industry policies, and real policies of competitors. You cannot become a very charitable concern when your competitors are realizing their receivables well in time. You have to put the industry policies right in front of you, the real policies of the competitors, the customer's financial strength. Sometimes you can just make a sort of special case that you have to do that, but not always with everybody. That's how you just take care of receivables. Inventory control. You see, you have to maintain an acceptable inventory size to deal with the normal operations. Not too high, not too low. Too low would be just affecting your credit worthiness, your credentials, and too high would be just having the investment idle for some time, which is, of course, sometimes is called a sort of a wastage of money. And demand fluctuations without over investing in the asset. Don't over invest when you just want to have the inventory control. Managing short term debts, short term financing management, like liquidity management, should focus on ensuring that the company has enough liquidity to finance short term activities without taking an undue risk. Accounts payable management, when we are just talking about the debtors or the accounts payable, when we are the debtor of someone, that means they are the suppliers where we are supposed to make the payment. Accounts payable is a result of trade credit issued by a company supplier, which is usually done a part of normal business operation. You have to just strike a correct balance between the early payment and commercial debt. Not to keep your debts for too long, to save your credentials, to save your reputation, and not too early so that you can keep a correct balance between the accounts receivables and accounts payable. Strengthening operational agility, strategic partnership. Companies are reevaluating their ownership of non-core asset as part of portfolio optimization and divestiture strategy, and considering shifting to an ecosystem of strategic partners. These partners who are often considered better owners or manager of such assets can assist in the move from fixed to variable expenses, enhance the enhance the company's agility, shift the resources to focus on critical capabilities, and achieve higher shareholders return. See, ultimately, when we are just keeping all those controls, all those management, all those, say, balance between the accounts receivable and management and the payable management, see, we are just, say, making an effort to save our money in time so that at least your liquidity is there whenever there is a need. You can just keep your reputation alive. You can keep your credentials for the future transactions, and ultimately you can earn sufficient number of profits also for your growth. Friends, with that we have completed our unit number 30. Now we are just working on the last unit, which is of course a working unit of this course, that is working capital management in multinational corporations. You see, what are the multinational corporations? After the setting in of the new international economic order, NEO, with the signing of new journal agreement on tariff and trade, the short form is the popular form is GATT, by a majority of the countries in the world and the funding of the World Trade Organization and the permission accorded to China to global trade, there had been a sea change in the international business environment. You see, the number of companies carrying on their business beyond the home country has been on the rise constantly. At the beginning of the latter half of the previous century, companies incorporated in countries such as USA, UK, Germany, and Japan used to set up manufacturing and trading facilities outside their country of origin. But now, you see, for this, the examples were Unilever, Coca-Cola, Johnson and Johnson, L&T, etc. Had business location in many countries in Asia, including India. Now, this scenario had got dramatically altered with the entry of companies from South Korea, Singapore, and China. There are new players now in the international trade, including India. As far as the Indian position is concerned, companies incorporated India are also slowly evolving and becoming global. Friends, as per the information of the Confederation of Indian Industry, CII, there are about 165 companies that have some kind of presence at the global level in terms of having manufacturing locations or trade relations. Notable among them are Tata Group of companies, including Tata Motors, TCS, Tata Chemicals, Bajaj Auto, Dr. Reddy's Lab, Infosys, Bharti Airtel, Bharat Forge, L&T, IOC, Wipro, and Vedanta Enterprises. Till around January 21, Indian companies have bagged 11 places in the list of 500 most valuable global 500. They included at the 54th place was Reliance Industries, 73rd rank was TCS, 105th rank was HDFC Bank, 119th rank was of Hindustan Lever. 201, 201st rank was of Infosys. 249th rank was of HDFC. 284th rank was of Kotak Mahindra Bank. 316th rank of ICICI Bank. 440th rank of Bharti Airtel. 451st rank of Bajaj Finance. And 480th rank of ITC. This was the status on January 2021. Now, the latest report says that is on as many as 155 companies have invested 22 billion in the USA, creating nearly 1,25,000 jobs in that country. See, friends, while it was common during the 1970s and 80s to acquire Indian firms by the MNCs of foreign origin, but now Indian companies too have started foraying into advanced countries through collaboration and acquisition. Now, Indian companies having huge cash surpluses and strong bottom lines are now eyeing foreign companies for acquisition. During the period of 6 years from 2015 to 2020. Friends, there were 910 outbound acquisitions by Indian companies, the highest of 183 recorded in 2018, involving a deal value of 33.5 billion US dollars. Most of these deals have happened in the sectors like pharmaceuticals, chemicals, and IT services. These developments emphasize the fact that things are going global and even Indian companies are coming of age and are stabilizing, necessitating the need of to improve operational efficiency by focusing attention on the working capital and fixed work capital management. Now, what are the special issues of concern in the operational environment? Although the basic principle of working capital management are common to national and international enterprises, there are certain special issues of concern that need to be cared for by the companies operating in the international environment. These issues exhort the companies to be extra careful in managing their working capital. The operational environment of the multinational corporations is impacted by these factors. They are the policies and practices regarding trade and industry of the home country and the host country will be at variance. It is always the restrictions prevailing in the host country will impact the operational efficiency of the MNC. This is the point of concern. If there is a restriction, definitely it will be impacting on your business also. Currency risk are attendant to the variation in the exchange rates. For a variety of reasons, the currency values of the countries will be changing. Such reasons may include economic slowdown, political instability, aggression from outside, etc. Friends, if suppose there is an economic slowdown, if there is a political instability or any aggression from outside, the currency are at a risk platform. The procedure and practice regarding imports and exports of raw materials, equipment, stores, and spares will impact the operational efficiency of the working capital. In some cases, there will be tie-up practices followed by the companies. Now, what developing country does? They follow the practice of encouraging indigenous material and method. Normally, in such cases, there may be restrictions on the import or export of certain goods and services because you prefer to have your own raw material, you prefer to have your own creation of the raw material as well. There are certain restrictions on the flow of funds between the countries would limit the investment of fixed and working capital. Suppose there is a restriction on the flow of funds. Like if we take the case of India, remittances by foreign companies from India are subject to the provision incorporated in the Foreign Exchange Management Act 1999. Specifically sections IIC.1 to IIC.5 of the Act condition the remittance of profits by foreign companies other than banks subject to certain guidelines. So there are certain restrictions, maybe because of the country's growth, but then it may just give a sort of other impact sometime by the investing companies in India. The next important factor is tax policies and procedure are yet another important issue that needs to be taken into consideration by companies. These are akin to an individual country. Taxation is one regulatory tool that is handy to the governments in regulating the inflow and outflow of funds. Trade restrictions like tariffs, quotas, and pricing have larger implication for international trade. If if you are having trade restrictions within the country, though free trade is encouraged at the global scale, yet regional trade agreements have not ceased to operate. Still, there are wide variety of bilateral treaties impinging on the free trade. All these restrictions imply MNC operations. Finally, there is an issue of transfer pricing. Usually, MNC will have business location at several places, but manufacturing or service locations will be at a few places. What happens? The value of the goods and services varies depending on the country of sale. The MNC has to decide the base price which is to be taken as common and add taxes of the buying country and other duties. So transfer pricing is one of the most difficult aspect in the case of an MNC. Because manufacturing at few places and sale at many other places. So transfer prices are coming out to be according to the prices, according to the currency, according to the other challenges of the different locations. Cash management. Friends, with the advancement in technology, there have been tremendous changes in the method and practice of cash management by companies within and outside the countries. Cash flows have become instantaneous with the introduction of electronic funds, transfer systems. In the short form, we say EFTs. It has turned quite common to domestic and MNCs to maintain multi-currency accounts, multi-bank transfers, and multi-bank reporting. Banks are increasingly becoming members of the Society of Worldwide Interbank Financials Telecommunication. The short form of it is SWIFT. It is popularly known The networks to ensure quick, accurate, and secure payment mechanisms. It is reported that about 11,000 member institutions are joining this network, conducting approximately 33.6 million transactions per day. The counterpart in India is the National Electronic Fund Transfer, NEFT. We do have the fund transfer mechanism, which is called NEFT, National Electronic Fund Transfer. It was introduced by the Reserve Bank of India. RBI, in addition, has also introduced a quick settlement mechanism in the name of real-time gross settlement. It is written RTS, but in a popular term, it is called RTGS. For quick and effective transfer of money between accounts. Friends, some of the services that are offered through these network includes ATM transfers, ATM transfers, direct depositing of money, direct debit or credit service. It could be told as under instructions. Transfers through credit card services, another way of doing business of financial services. Wire transfers via SWIFT, as we have said earlier. Online payment services. The India is now growing with the online bill payment on a very, very fast pace. Services involving private currencies, if required, and subject to home country and host country regulations. And finally, instant payment services. You can just put up the papers and instantly take the cash by having the predetermined provisions and agreements we have. Issues in international cash management. The following are few such issues that need to be taken care of by the cash management of an MSC. Friends, there are differences in the banking practices followed by bank in different countries. Usually, bank in any country are supervised and regulated by the central bank of the country. In our case, it is RBI. There is going to be a stated procedure to be followed by each bank in dealing with overseas transactions. The transaction fee and range of services vary widely from country to country. Differing economic and monetary environment also make cash management more complex. For the manager, in addition to the risk associated with the fluctuation in the value of the currencies due to vagaries in the economy, the exchange rate also proved to be unkind. Basically, a challenge. This is particularly timely in case of currencies of low income countries. When there is a low income countries, the currencies are also coming up and behaving differently. We have noticed in the earlier discussion that technical advancement have revolutionized payment mechanisms just few minutes before. But the impact of changing technology will not be uniform. We have the change of technology every now and then. Some countries may be more forward in adopting these technologies, the changes, and they are swift in action. Yet others may be slow runners. Many factors could be. The internet and communication network may not be spread widely, and there may be areas still unattended. In some parts of the world, the continuous supply of electricity itself is an issue. I remember when I was just, say, conducting the class in the, say, BCom courses for African students, many a times the students were just complaining that they didn't have the electricity. So the network was also getting affected, and they were getting a sort of setback in their attending of class online. All these naturally limit the speed of the transaction. The use of electronic network also should be taken into consideration. Another important issue for consideration is the legal barriers imposed on the movement of cash or transactions happening through banks and other financial institutions. Yes, legal awareness and legal complexities are to be there for a better financial health, but sometimes it just gives you a sort of setback as well. So we are aware that the flow of funds from NRIs is also regulated in India. Such restrictions may be imposed for want of ensuring cross-border liquidity or to fight over the external exigencies. Sometimes secrecy is maintained for security reasons. It is also interesting to know that cultural issues have a role to play in payment preferences. It is known in India that individuals and companies avoid payment on certain days. In some small talks or entertainment programs. Time zones are another issue of concern to a cash manager of MNCs. The overlapping of timing and days and nights leave an impact on the business hours. Companies need to schedule their activities in such a way to adjust those time differences. Like now, it is a daytime, but in Canada, it would be midnight. When you just come out to be at a 6 o'clock today, it would be around, say, 8 o'clock in the morning. So, like that, these are the time zones and time differences. So, the multinational companies, they have to just set up their plan in such a way that they are not having a sort of bad impact because of the time difference. Managing inflows. The objective of cash management, either in the context of domestic companies or international companies, will be same. Economists have identified three primary motives for holding cash by individuals or institutions. They are transactional motives, precautionary motives, and speculative motives. Of these three, the first two appear to be more relevant. Yet we cannot ignore the speculative transactions carried out by the companies, especially in the time of emergencies, uncertainties, and rising prices. So first two are common, and speculative is coming out to be rare, yet it is prevalent. Few issues that need to be cared for are the MNC may permit to hold the cash in the currency of the host country and also make investment for the same from to time there. Or the firm may decide to centralize all investment decision and thus instruct every subsidiary unit to transfer the surplus to the home country. However, transfer of income surplus will be subject to that host country's foreign exchange management guidelines. Like we just said, IIC 1 to IIC 5. Minimization of transaction cost involved in the currency conversions calls for holding adequate cash balances in the currency of the host country for immediate and future payments. Yet another problem in managing the cash inflows by the MNCs is in the proper estimate of cash flows. This is all depends on the turnover expected from the host country. While it is possible to some extent to estimate the rates that would be happening in the host country, it would be beyond comprehension in respect of currency appreciation and depreciation. The values of the currency of the host country fluctuate for a variety of reasons. To a host country, to a great extent, a majority of them are beyond the expectation of the company. A small change in the policy of the host country, like FDI permission, may cause a big difference in the currency valuation. The currency valuation. The usual practice is that the currency appreciation would encourage the host country domestic companies to explore more and export more and import less when the converse is true. Finally, there is an issue. Host country guidelines blocking the movement of cash from their country. Several developing nations promote investment and employment of their in their countries, but certain restriction on the size of transfer funds. In such cases, MNCs are required to devise way to tackle the situation with due care and diligence. Managing outflows. In this regard, the usual technique is to centralize all the payments. Centralize all the payments. There will indeed be greater control over the cash situation in the present scenario because of the technology, but it may not be possible in the present day circumstances. Centralized systems were suggested in those days when negotiable instruments like checks and bills of exchange were popular. But nowadays, when there is a sort of technology which has just come up, now you can decentralize them also, having a sort of dashboard information right at your computer. Now, all the payments are done through the electronic mechanism. Therefore, delaying the payment will not be possible through centralization. A centralized system of cash management indeed has the advantage of holding overall cash to the minimum. This would also enable the company to make full utilization of the cash available and avoid idle cash balances. This is another scenario, thus securing a return on the cash holding. The following are the two systems that are widely followed by MNCs. Multilateral netting. There is a payment mechanism where two or more parties join together to sum up the transactions that happened in a specified period. This could be applied to the units or branches of the organization or can be arranged with outside parties. The implication is that netting activity is centralized in one place, avoiding the need to prepare and raise multiple invoices for setting payments. Physical and notional cash pooling. Yet another method of centralized cash management is to resort to cash pooling to both physical and natural forms. Usually, nobody would prefer to opt for physical pooling due to various restrictions imposed by the countries in the handling and movement of hard currencies. But the COVID 19 pandemic has led many MNCs to hold large cash balances to maintain a liquidity position in those difficult times. Investing idle cash. Now, this is somewhat you have to just know about. If you have the idle cash, if you have the excess cash with you, you have to invest them for the short term investments. With regard to the receivable management, we have to make a policy how much credit we get, how much credit we just give. So there should be a perfect balance between the two so that your receivables are collected well in time so that you can make the payment to the accounts payable swiftly and to save your credentials. Friends, for inventory management, there is an old age saying that inventions are the grave end of business. Now, if suppose you are just taking more inventory in your businesses, it is the money which has been invested for some reason. If the reasons are not adequate, then it is a sort of investment without any result. But if your inventory is short, it is again just coming out to be the impactful event on your credentials. So in both ways, we have to just keep a perfect balance in the inventory requirements. We may have to just reorder. We have to find out the ABC analysis. We have to just see what is our level where we have to order for the fresh raw material or finished goods. Some of the usual and most frequently resorted mistakes by the MNCs can be said of the following. What are the basic problems we are just facing? Holding too much or too little inventory in one location, lack of diverse inventory items, an adequate number of warehouses, an inadequate number of warehouses, difficulty in movement of inventory items from one location to another location, lack of coordination. This is the most important thing. Lack of coordination amongst the multiple locations within the same country and between the parent company and subsidiaries in the host countries. To just overcome all these problems, the supply chain and inventory management has come up. A new trend in management of inventories is towards cultivating supply chains. Businesses are always in search of new and innovative processes, and new development in this regard is the supply chain management, SCM. This combines a wide gamut of activities covering manufacturing operations, purchasing, transportation, and physical distribution into a unified activity. The intention is to create a seamless process linking all the players in the chain. Many of these activities have a direct bearing on inventory control, such as procurement, transportation, warehousing, forecasting, production, planning, scheduling, etc. In a wider sense, the supply chain is set to extend to all those activities associated with the movement of goods from raw material stage to the end user. Supply chain integration implies not only the internal departments but also extend to the external agencies like the suppliers of raw material, transporters, warehousing firms, etc. Finally, supply chains are designed to play an important role in moving goods more quickly to their destination. It is also important that a common framework is developed for analyzing the efficiency of the players in the chain at every level and on each occasion crucial to the chain. Friends, with that, we have completed the course MMPF 001 on working capital management. I earnestly thank the Regional Center Noida and the other functionaries who have arranged these sessions so swiftly and for the ultimate benefit of the students. Thank you so much. Namaskar.
थोड़ा टाइम लेना होता है